Nick, so good to see you. Today, we're going to talk through three financial planning and investment opportunities in a down market. So recently, stocks closed out their worst quarter since 2022. The S&P 500 and the Nasdaq logged their worst performance since Russia's invasion of Ukraine. So before we get into how to take advantage of this down market, I want to talk through something we've talked about before, which is the concentration risk in the S&P right now. 80% of the market's movement is due to only 10 stocks. And considering the Magnificent Seven, which we've also talked about before, they've lost more than $2 trillion since the start of the year. What do we need to keep in mind when we see this much red on the board? This is looking back 1 month performance.
Right. So, red on the board, it's kind of in relation to a sale at the store. We think about going into a store, we're not just going to buy the most expensive item. Usually we want some sort of deal on that. And the stock market works the same way. There's going to be ebbs and flows in a stock market that, we see a little bit of a sell-off. It gives us a buying opportunity inside of that. Now, does that mean that that's sale isn't going to go a little bit deeper, possibly? Who knows? That's the uncertainty of it. Long-term wise, when we look at these Mag 7 companies and the whole market, in general, are we finding quality pieces? Are we finding something out there that, is going to be there long-term? And when we look at that Mag 7, they're all tech companies. I've said this to clients for years. I don't think that we're going back to typewriters or stone and chisel anytime soon. And I do think that tech is going to be something long-term that has substantial growth. So we've continued to invest in that. And as markets pull back, we'll continue to put more in there. Now, you brought up the concentration risk, as well, too. And that is a concern because, if we go back to the tech bubble, we had concentration risk of the top 10 stocks of about 27% of the market cap of the S&P 500 was made up, of just a few stocks. Today we've got those top 10 companies of the S&P 500 make up about 35% of the market cap, and they make up a little over 80% of the returns in the S&P 500. So that is a concern that, as those 10 stocks go, so does the rest of the market. So it's not a real good identifier of market performance overall. It's a good identifier of those 10 stocks. But we've got to be careful of that, when we're buying into it. Could we see a little bit more of a sale, from this? Yes. I think all the time, markets are going to go up and down. There's no new news. I'm telling that to anybody. But in the long run, I think, we are going to see growth in those quality companies.
Okay, so now let's get into the 3 tips to handle this down market. Number 1 is put your cash to work. A lot of people feel more secure when we are hoarding our cash, but that really does compromise your ability to build wealth over the long run.
Right. So it is good to have that cushion, that it's a safety pillow for everybody to have that cash on hand to be able to use. But it's also an opportunity to deploy that excess cash. We always talk about having about 3 to 6 months worth of expenses held back in savings. Once you get above that, now all of a sudden that cash isn't growing nearly as much as what the stock market or equities are doing, or even, what bonds are doing. Bonds so far this year have actually done some positive returns and have done well overall. So a balanced, diversified portfolio, can still be a positive influence to somebody. I'm not saying go out and buy, Bitcoin or some, individual tech stock, but when you're going out and you're buying quality funds and quality stocks, over the long run, you're going to have, a better return when you're buying low and, ultimately later years selling high.
All right, so next let's talk through taking advantage of your stock losses using something called tax loss harvesting. Can you explain how this one works for us, please?
Yep, absolutely. So we don't always buy into stocks and expect a loss, but some things happen. Hey, we had a little bit more optimism, when we bought that stock and, it just hasn't turned out. The CEO led us down, the wrong path on something like that, and we end up with this loss. And what the IRS allows us to do is to sell that loss and capture the loss that we can use towards maybe some other gains that we had somewhere else in the portfolio. So we can, net neutralize, our losses so that we can eliminate a little bit of our tax bill as well. Or we could have carry forward losses, that we can use in future years with it too. We do have to be careful though of some wash sales. If you're buying, or I'm sorry, if you're selling that stock and then turning around and buying it right away as the stock starts to rebound, some of those losses could be washed out, and we don't get to partake in the full loss of that. So you want to make sure that you follow the rules carefully on that.
Right. And last, explain why a Roth conversion makes more sense in a down market.
Right. So when we have IRA money that has taken a loss, when that money starts to grow back, it's still growing back in that tax deferred and ultimately going to come out taxable. So if we are pulling money out of pulling money out of the IRAs and converting that over to the Roth, converting those shares into the Roth, now as that market starts to come back, we're able to, capture that upside of the market in a tax-free way. Okay, so we're able to, still pull out, if we wanted to convert over an S&P 500 share, shares are down right now. We convert that over into the Roth IRA. Ultimately, the S&P comes back at some point from this, and we're able to capture upside tax-free growth with that Roth conversion. So down markets, always make for a good time, to do some Roth conversions if it fits inside of your tax bracket.
Great. Well, I think that a lot of people are a little bit on edge with everything they've been hearing. So if somebody would like to come to you to talk through these strategies to take advantage of this volatility, what's the best way to reach you?
Right. So they can reach out to us online, icanberryretirement.com. You can either schedule an appointment right there online, or you can give us a call at 937-498-1128. And we can set up a time to get together to talk about, different strategies and how they're going to work for you.
Great. Nick, thank you.
Thanks, Erin.